How are the observations as far as the market go, budget, earnings quality? We have Harish Krishnan who is joining us now, and Harish is joining us now in his new role. Aditya Birla, Sun Life AMC. He is Co-CIO and Head of Equity. Harish, good to see you back, and congratulations on your new role as well. Before we talk about all the other stuff in the market, so what's up with the new role? What are the changes you've implemented here and the direction you'll be taking?
Thank you so much, Ajay. Always a pleasure to be part of your show. Yes, it's a new role, it's a new responsibility to try and to right by our unit holders, and to do so in a fashion that we, in terms of our greater focus on some active high conviction bets that we take, and in a manner in which we give a reasonably superlative consistent performance. So that's the endeavor of any active manager, and we are trying to work around processes, people, and technology to try and achieve this endeavor out here at Aditya Birla Sun Life AMC.
Aditya Birla Sun Life AMC is already doing a great job in the overall asset management space. Obviously has its own space as well, place in the order as well. But I understand that the business is pretty brisk. 18,000 crore SIP, a fresh record high. Retail investors becoming the third front. Are you also expanding your team? And I understand that there is a lot of work. People not only expanding the team, people are on the street expanding their coverage. What exactly will be the new focus in terms of processes or additional work we are looking at doing here?
So yeah, from the investment side, we always have to find our edge, and we have to do a differentiated take, a variant perception of how things are being played at. Clearly, investment is both about numbers and narratives, and we need to get a better edge at both numbers and narratives. So, to that endeavor, we made changes in people. There are a whole bunch of fund managers who were very seasoned, tenured analysts at our firm who've taken on bigger responsibilities. So therefore, there's a greater desire and a hunger to perform for them as well. We've also beefed up our resource strength. As we speak, we've got about 15-member research team. We are going to add and expand to that so that clearly this is a time frame where the universe of opportunities are also increasing, and we want to give a greater focus in terms of depth of research rather than just merely breadth of research. So that's the second key change that we are focused on. The third is to use technology. Technology, while it can come in very handy in terms of market creation and getting customer, satisfaction scores, etc. I think technology is often unexplored when it comes to investment. And out here at Aditya Birla Sun Life AMC, we're making some significant strides as to how do we incorporate greater use of technology in terms of objectifying the various subjective elements which are there. So be it in terms of, say, management scorecard, be it in terms of, say, the group think of how the 30 odd investment professionals that we have, how they are thinking of various dynamics, so that we get a real-time dashboard in terms of the various perspectives that are there. And we then try and marry it to the fundamental views that our analysts carry to try and help improve our odds and therefore to get a better outcome for our unit holders. So there are a lot of things happening at this point of time, be it in people, process, as well as technology to sharpen our edge.
Harish, of course, this is my personal observation that you also bring another edge to the table, which is a wonderful and very differentiated macro edge. And we are operating in an environment where returns are getting hugely impacted by the dynamic macro scenario. I want to take the discussion forward on that one. The government has taken a very interesting move of keeping fiscal deficit target lower than what the street was estimating without compromising on growth. And it appears that the 7% growth figure is something which multiple agencies at the government level are repeatedly talking about. If we do aim at 6 to 7% kind of growth on a prolonged basis, with the disinflationary environment and rates heading lower, what can it do to equity as an asset class for the next 2 to 3 years?
So I think this is a very pertinent question, Ajay, that you've asked. And I want to highlight 3 points, when it comes to macro discussion. two are outside of the budget and one specifically to the budget, the vote on account budget that was presented yesterday. So we did this work when it comes to macro. So, over the last 25 years, whenever we used to meet, say, foreign investors, the constant feedback that would keep coming through is, hey, you've got such great, interesting management teams, superb management teams executing on the ground. But one thing that we are always wary of in India is the macro vulnerability. Every 2, 3, 4 years, we get inflation prints that take away significant currency returns by way of depreciation. And therefore, we always struggle in terms of how do we marry that macro with the micro. I think, the last 4, 5, 6 years, we've seen a significant appreciation of the macro. And this feeds to in terms of my second point. But when I say appreciation of the macro, so if you think of the three asset classes of be that of equities, bonds, and currency, while in equities, one can always say that, because of the domestic SIP book, etc., the full expression of foreign investors is not being felt. If they have a negative view, it's getting absorbed, etc. And in the bond market, it's still very much owned by the Indian financial institutions. Whereas in currency, it's reasonably completely open. Now, the key observation that we saw was the range of high and low. Against the US dollar for the Indian rupee. And that we tracked against about 15, 16 large economies and currencies, how that range has moved. And we are now at a zone where in the last 3, 4 years, we are at the lowest decile compared to 15, 16 other economies. Now, what this says is that, over a period of time, the appreciation of the macro is starting to be felt by the investor. And this has not only got implications to the investor, it has got implications on the risk premium that people are willing to take, as well as on implication on exporters and importers. When you've got a reasonable stable currency, you can focus more of your time and energy in terms of doing your business rather than necessarily worrying about this curveball that can come from currency. So that's the first point that I think the government has done very well, both the government and the regulator and the policymakers, and that continues to get reinforced into the vote on account budget. Now, the second observation with respect to the budget that got presented yesterday, and which I thought was a significant positive, was clearly that of the fiscal deficit, as you rightly called out. But I think an even better nuanced take would be to look at the primary deficit, which is basically you leave out the interest cost, because interest is basically of the debt that you've already taken in the past, and that's a contractual obligation that you in which case have to do, right? So from a primary deficit, I think we are tracking very, very well. And if the glide path of what the government is saying in FY26, we would reach the same primary deficit that was there pre-COVID. I can't think of many other economies, because across the world we've seen stimulation by the fiscal authorities. I can't think of many other large economies which have done this heavy lifting, hard work of being truly countercyclical. And that I think will find a lot of appreciation. The third point, and I think this is the point which specifically focuses on asset classes, is that if you look at how the deficit has gone, right now, clearly from a subsidy or from a revenue expenditure, etc., that has now come back to the pre-COVID level. So while the government deficit is still higher, a bulk of that deficit is primarily going on in terms of interest service. That's the point that I just made out earlier. Now, if you look at that construct, and given the fact that all the interest expenses are reasonably in-house, in the sense that almost all our instruments are owned by the Indian households or Indian institutional. Basically, it means that you are now seeing a tenure where investment and capital owners is being given a slightly higher thrift compared to that of the consumer. So I think while there is no right or wrong, I think we do think that investment will take precedence over consumption. And that is how we think that markets will get rewarded, even in terms of, say, any asset class of real estate or be that of equities.
Right. Harish, can I just interrupt there? I'll request you to please hang on. A lot of other stuff also need to be discussed with you. We'll take a very short break, come back and take the chat forward with Harish Krishnan, Co-CIO and Head of Equity at Aditya. Beat the Street right here on ET Now. Harish Krishnan is still chatting with us. Harish, if 2023 was a year of low volatility and good returns, it appears that as we have entered 2024, things are just becoming reverse. At least the volatility part is going higher. How do you think the investor behavior and the factors would be as volatility increases and bulk of the low hanging fruit on the return front may have already been made?
Right. So yes, Ajay, this is our base case as well, that we think that this year, while or the next 18, 24 months, while still will reward investors, will be a lot more selective and polarized rather than the entire length and breadth which has got rewarded. Just to illustrate that point, last year, almost 50% of the top 500 companies had an alpha of 10% compared to NSE 500. And that's one of the highest readings that we've seen over the course of the last 15, 17 years. So therefore, we do think that there is going to be a reversion to this breadth of the market, which has got rewarded very well, and pockets will be far and fewer. I think investors are reasonably maturing in Indian markets. Clearly, we have seen a reasonably low volatile kind of an environment where investors have got rewarded. I would think that they would use this opportunity to identify sectors, to identify funds, and to identify themes, wherein in this volatile phase, they would want to allocate so that they can ride that wave for the next 2, 3 years. So that's our advice, and we are in cognizance of that theme, that it's going to be a lot more polarized in the year 2024 in terms of where one is going to get returns from.
Is also earnings quality or the growth a big risk, because we are in the middle of the earnings season, and my observation shows that a large section of the companies actually have shown flat to slightly negative top line performance. Yes, the bottom line has been very good. Margin expansion is the order of the day. As we go into the year, do you think this is one big monitorable, the revenue growth front?
Absolutely. So clearly, last year itself, what has helped companies and earnings has been margins. And if you were to look at from a macro prism, margins are a variable of WPI and CPI. WPI is what the company sees, and CPI is what the consumer sees. And we have seen a zone wherein WPI minus CPI was at an extreme position, benefiting companies last year. So I think we are going to see some of that tailwind normalizing. So therefore, some of that easy margin expansion that we had seen is going to come through, will be a lot more circumspect. And therefore, the heavy lifting has to come from revenue growth. And clearly, we are seeing some kind of a reduction in that growth rate. It's still growing, of course, but the reduction in growth rates that we had seen, partially because, the base from COVID, wherein you had that entire unorganized to organized, you had revenge consumption, you had commodity-led gains. A lot of that is already in the base. So therefore, we do think that top line is going to moderate quite significantly over the course of this year. And therefore, which again ties me to that same point that we made to your previous question, that the pockets of growth is going to be a lot lesser, and therefore one has to be a lot more careful and selective this year in terms of the sectors to back.
So one last word before we let you go, Harish. Which are the sectors where you truly think there is valuation comfort right now? The earnings growth actually would be able to be keep pace with the kind of PE expansion which already has happened in the market.
So I'll slot it into two buckets, Ajay. First are the dark horses, where it's not necessarily only about earnings coming through in the next 6, 12 months, but it is about valuation comfort and the fact that, there is very low ownership in those space, as well that, the last 3, 5 years haven't been that great. Topping that pack, I would say, is pharma, which I think is a dark horse sector, where, promoter ownership is quite high. Companies have deleveraged quite significantly. API prices have started coming off. And so while it is a very bottom-up sector, given the fact that each company is, very individualistic and different, I would still think that that could be one space. Similarly, could be metals. I think we have peak China negative sentiment sentiment, if I may use that word, as at this point of time. And when pushed to a wall, I think they would come back with some kind of a stimulus. Indian metal companies are reasonably deleveraged compared to the previous cycle for sure, and that is again a pocket which I think from a value zone can come through. The third is media. This is a sector which this is in fact one of the very few private sectors where we are seeing profit pool share of media sector is actually higher than the market cap share of the media sector. Effectively, people are questioning the terminal value of the sector, which we think can and for 10 years the sector hasn't done anything remarkable in the stock markets. I think this could be a sector to watch out for. And the fourth is consumer durables, wherein post the Atmanirbharta, a lot of capex has happened into India. Unfortunately, sales have slowed down. But given the strong real estate sales that have happened from 2020 onwards, wherein possession is likely to start coming through, from 23, 24, 25, we do think that there can be a scope for consumer durables to do well. So this is from a value pack point of view. From a earnings and where comfort is more, essentially are about four other sectors where we think sectors which have done. Second is capital goods and engineering. Third is auto, and fourth is IT and cement to kind of finish that pack. So these are the 4-5 sectors where we think, of course, it will be a lot less. The returns will be a lot more moderated than last year, but we do think that the cycle is still good from an earnings point of view. Where we think we are a bit circumspect is in terms of the smaller banks, where we think there has been a lot of gains which have been made in the smaller banks and NBFC. That would be one space. FMCG, consumer is another space where we think earnings can get cut, and they still are at very lofty valuations. The third space where we are a bit circumspect is on defense, where again it's got re-rated significantly. The price to book of say the defense index is more than the price to book of the consumer index on a trailing basis. I don't recall a single instance where valuations have moved up so significantly.
Right.
So I think these are broadly our sectoral calls for the medium term.
Thanks for that, Harish, for that take. We'll take the discussion a little more in detail the next time you come on our show, but good luck on your new role as well. Thanks very much for joining us today. Take a short break on the show. On the other side, closing trades will take the action forward.